Hello viewers, welcome back to our YouTube channel, and today we are going to look at another session regarding the books of original entry. Books of original entry. Some books call them day books. So we are going to look at books of original entry, or what we call the day books. But you have to remember that we already spoke a lot about what we call the accounting books. We spoke a lot about the accounting books, and I'm going to take just a quick recap of what we have done so far in regards to accounting books. But our focus for today is all about the books of original entry, or what we call the day books. We have so far learned the accounting books, or the accounts books, or the books that we use in accounting. We have learned that these books can be split into main categories. We looked at the fact that we have what we call principal books. We looked at principal books, and at the same time, we looked at what we call the books of original entry. Books of original entry. And these books of original entry, they can also be called subsidiary books. But we prefer to call them books of original entry. But now we saw that the principal books are the ones that we call ledgers. We saw that these principal books are the ones that we call ledgers. And these subsidiary books, or the books of original entry, if you don't call them subsidiary books, we usually call them books of original entry. However, under the principal books, we said we have what we call ledgers. Under the principal book, we said we have under the principal books, we said we have the ledger, and this ledger is the main principal book. The ledger is a principal main book, or is the main principal book, as well as the cash book, which is also seen as a ledger. And the reason why these two books are called the principal books is because they follow what you call the double entry system. That is the main reason as to why they are called principal books, because they follow what you call the double entry system. That is the golden rule of accounting. Now, when we talk about the subsidiary books, these subsidiary books, these are books where transactions are first recorded, meaning that these subsidiary books, that's where transactions are first recorded before they are transferred, or before they are posted in different respective principal books. So we first register within the subsidiary books before we transfer those figures to posting them in the ledgers and the cash books. So what we are going to do is that we are first going to learn how to record transactions in the subsidiary books. So you first have to understand how to record the transaction in the subsidiary books. And we've said that these subsidiary books can also be called the day books. If you don't call them the day books, you can call them the books of original entry. And the whole meaning is that these are the books where transactions are first recorded before they are transferred to the main book, the principal books. As I've told you, the categories are two. The categories of accounting books are two. We have the principal books and then the subsidiary books. But within the subsidiary books, that's where transactions are first recorded before they are transferred to the principal books, which includes the ledgers and the cash books. So what we are going to do is we want to first learn how to record the transactions into the subsidiary books, which are also called books of original entry or the day books. Day books means it means a day, then a book. Something that happens on a daily basis where we record it. That book is a subsidiary book. And afterwards, after recording that information in that first book, we will then learn how to post transactions in the different ledger accounts. And that's what we are going to be doing. But before I list the various books of original entry, let us look at the names that we give these books, because I told you that there are so many names that we can give these first books. So among the names that we have listed, I want to add on some other names that you might find, because I don't want you to find a name and you start asking yourself whether it's really the so-called name. The other name that I want to add on these three is that we can call them books, because we are going to be looking at different books. Different books give them different meanings, and I just don't want you to get lost when you find that they have named in a different way. So other books, they call them books of prime entry, books of prime entry, and sometimes they are generally called journals, and some of the other books might call them books of first entry, books of first entry. Then other books, they call them day books. If they don't call them day books, they call them books of original entry, or they call them books of prime entry, or books of first entry, or they call them subsidiary books or journals. So all these names, they mean one thing, or they are representative of one kind of books. They all mean the same thing. So all these are books in which transactions are first recorded. And once there is a transaction, for example, you can get an invoice or anything, then you first record it in a particular book of original entry before you post that transaction into a ledger or other principal books. And that's basically the reason why they call them books of original entry. So since it is the origin of double entry, then they have to make sure that you have all these documentations done in the right way. But the key issue when you are recording the transactions, they are recorded in the order of their occurrence. So what you have to note, having known all these names, the key issue is that we have to record the transactions, transactions in their order of occurrence. In other words, we put them in what we call a chronological order. In other words, if a transaction happened, let's say we are in January and the transaction happened on 1st Jan, it should be written first. The one that happened on 2nd Jan should be written second. But not having a transaction that occurred on, let's say, 5th, or that happened on 10th, let's say 10th Jan, to be the first transaction that will appear in that book. No, you write these entries as they are occurring, meaning you are right. That's why we are saying they are books of first entry. That's where you first record the transactions immediately when they have happened. before you transfer them to other books, because even when you are transferring to other books, you have to follow the order. You can't put a transaction that happened on 22nd and you put it as if it happened on 1st of that month. So that is the whole idea. It is very important that we follow that order, because you cannot record a transaction that happened on a given date and you record it as if it happened on another date. As long as those transactions they were happening in the same month, they should follow that chronological order, or in the order of occurrence. Now, I'm going to list down the books that follow into this category, which are the books that we call the books of original entry. So I'm going to record all of them and we see what we have. So let's have a list of books of original entry. The first one, we have what we call the sales journal. Remember, I told you it can also be called a journal. The second one, we have a purchases journal. The third one, we have what we call sales return journal or the book. The fourth one, we have what we call the purchase return journal. And also we have what we call the general journal. And finally, we have the cash book. But let me write this cash book using a different color. I will explain why. This cash book, because we have seen a cash book appears in books of original entry and at the same time appearing in the principal books. And the reason is very simple. We say that a cash book is appearing in the principal books because it follows the double entry system. That's the only reason as why it is categorized the other side. But otherwise, if it wasn't following the double entry, because when you are recording in a sales journal, we don't follow any order. We just follow the order of occurrence. But when you are registering in the cash book, we register transactions following the double entry. That's the only difference. So this one we just follow the order of occurrence, but the other side in the principal books will follow the double entry system. So if you are the one, maybe you have been wondering why we are writing a cash book here, is because a cash book, of course, we know that in accounting, a cash book is the only book that belongs to both the book of original entry and at the same time belonging to principal books, or what we call the ledgers. And it's belonging to the subsidiary because the transactions are first recorded in them. And it's the book of original entry for all the cash transaction. So this records everything that has to do with the cash. So that's why we are saying it is belonging to the books of original entry, because it records transactions for the first time as they are occurring, as long as they are cash in nature. But the other argument is that when it comes to principal books, it belongs there because a cash book, even though it's a book of original entry, also follows a double entry system. And those books, those principal books, they are there for them to execute the double entry system. And also a cash book does that. It executes the double entry system, which means that these first 5 books of original entry don't follow the double entry system, and that's the meaning. That's why you are seeing me putting it in a different color. So these first 5 books, they don't follow the double entry, but this one follows, and that makes it to go into the principal books and at the same time happening under the subsidiary books. Now, before we move to the practical aspect, which is the main objective for this video, I want to emphasize on some important aspect of what we are going to be doing, or what we are going to do. And we are going to look at the purpose of these books, each one of them. For example, if let's say we look at maybe the sales journal, for example, this first sales journal. Sales journal, the sales journal, for example, the purpose of this sales journal is to record credit sales. The purpose of this credit journal, the sales journal is to record only credit sales. So it records credit sales alone, and any transaction other than a credit sale, it will not appear in the sales journal. So the sales journal will record credit sales alone, and any other transaction that is not, that will not come to that sales day book. So when you are going through the transactions, because in the exam they are going to give you a list of different transactions that transpired or that occurred on different dates. When you go through those transactions, you have to make sure that you look out for the credit sales, and you know that those are actually going into the sales journal. But if you see maybe a cash sales that are cash in nature, please don't be tempted to put them in this account. Then the other thing that doesn't fall into the sales journal is a sale of a current asset. Sorry, a sale of a non-current asset. For example, we have sold, let's say, a motor vehicle, and our business is not dealing in selling motor vehicle as its inventory. Then we are not supposed to include that. Would be called a disposal of a non-current asset. So as long as you are seeing there is a sale of a non-current asset and it is not a sale that we know, of course we know a sale, it is from the normal trading inventory of the business or stock of the business. If the company doesn't deal in selling, let's say, those non-current assets, because it might be a property agent, a property company where it buys and sells land and buildings, then it would mean that their inventory would be those land, even though they are fixed assets, but that would be their inventory. But as long as that's not the case, then we are not supposed to include that into our sales journal. So whenever we talk about a sale, we are basically looking at disposal of stock or inventory. Now, when you look at, of course, when you look at these, the purchases journal, when you look at the purchases journal, it also caters for credit purchases alone. This purchases journal caters only for credit purchases. And that means that apart from these credit purchases, we don't bring any transaction into this purchases journal. We only record credit purchases. If the purchase happened on cash, then it's supposed to go into the cash book, because a cash book is the only journal that records cash transactions. So when we say purchases in accounting, we are referring to the goods or the stock or the inventory that has been bought with the intention of reselling. So whenever you see that maybe the business has bought or has purchased a non-current asset, we don't call that a purchase. Purchases are only stock that we bought for the purposes of reselling. And what we only include in the purchases journal are the purchases that happened on credit alone. If you purchase using cash, you have to transfer that to the cash book. Now, let's look at the sales. Let's look at these sales return journals, or what you call, sometimes they may call them return inwards journal. And these are returns of credit sales. This handles credit sales returns, what you have sold and they have returned it. Maybe the product was not functioning well and the customer returns the good. That's where we record it. But we only do that if the sale was on credit. If something had been sold for cash and the customer has returned that product, we don't record it in the sales return journal. We only record transaction that initially happened on credit. If the sale wasn't on credit, we don't include it. So when the return of a credit sale is done, we record it in the sales return journal. Now, when you look at this one, the purchases return journal. The purchases return journal will be for returns for credit purchases. Whatever that we bought on credit, and maybe we found, maybe the supplier sent the commodities, but we found maybe the commodities are not aligning with what we requested. Maybe we requested for soap, but maybe for a specific type of soap. Then the supplier gave us a different brand. Then we can return as long as it was on credit. But if we had paid money, then the adjustment would not be done within the purchases return journal. It would be done in the cash book, because the other supplier will have, either if he doesn't have the brand that we want, the supplier will return back our money. But here we don't have any, we have not paid money. It means we are only reducing on our debt, on our debt with the supplier, because we didn't pay the money. So you have to get this very clearly. The moment you get them, you never fail anything to do with books of accounts. So you can now see that these first four books, the sales journal, the purchases journal, the sales return journal, and the purchases return journal, you can see that those first four books, they are dealing with credit purchases or credit sales. So the first four books, everything is on credit transactions alone. And those are the only things that are going to appear in those books, these first four, the books. But now when it comes to the cash book, this last one, when it comes to the cash book, then it's for all cash transactions, as long as there is cash movement, any cash movement, as long as there is a cash transaction, there is movement of cash, either cash coming in or cash moving out, then we record those transactions in the cash book. So here with the cash book, as long as it is a transaction that happened on using cash, we don't care whether it is which item, whether it is a sale, whether it is a purchase, whether it is part of purchases or it is part of the non-current assets, as long as it happened by cash, whether you are selling assets. So once they are involving cash, either coming into the business or going out of the business, then we will record that transaction in the cash book. And that's the reason why these four books, these are the four books that are on credit transaction, and the cash book is for cash transactions. Now, I want us to look at something different. We know that we have cash transactions and credit transactions. And I'm saying that all cash transactions are taken to the cash book, and all credit transactions. Remember here, I've told you that all cash transactions are going to go into the cash book. All of them. We don't care as long as cash was involved. But the other thing that you need to note is the fact that not all credit transactions are covered by these four books. These four books are specific to each item. They are handling a specific item. But there are those things that are going to happen on credit, which are not going to be sales or purchases or any of their returns. The moment you realize that it's not a credit sale, it's not a credit purchase, it's not a credit sales return, and it is not a credit purchases return, then the question is, where does that item go, since it is on credit? Remember, if it had happened on cash basis, then it would have gone to the cash book. So you have to note that not all credit transactions that are covered by the business are going to be recorded in these first four books. Those first four books only covers purchases and sales. Therefore, we need to ask ourselves, what happened to other credit transactions that are not purchases and sales? So all these other transactions that are not purchases and sales, they will have to find themselves in what we call the general journal. Therefore, once you look at any transaction, any general transaction, after removing those transactions that we have specifically looked at, that are meant for some books, then the general journal will take any other transaction that is not belonging to any of these other four journals that we spoke about. However, you will also need to note that the first four books are specifically made for specific transactions. The cash book is made specifically for cash transactions. But for the general journal, there could be so many other transactions that could appear in it. Therefore, we call those special journals that are specific for certain transactions. And if you want to talk about specific journals, then we have to give special books of original entry, because for them, they are tailored to a specific transaction, except the general journal. So some of these things, as I emphasize on them, because I know some students are going to be doing some objective questions. They may tell you which of these item or which of these day books is not a specific book of original entry. That would be a general journal, or what we call, sometimes they call it a general proper. Now, what we are going to do is first focus on these first four day books. And for the cash book and the general journal, we shall have a specific video lecture on them one by one. But these first four, since they are going to be looking at a specific item, then we have to make sure that we handle them separately. So I want us to learn how we can make entries in a sales journal, how we can make entries in a purchases journal, how we can make entries in a sales return journal, and how we can make entries in the purchases return journal. And remember that I told you that these are credit sales and credit purchases, and the returns of both of them, that's how we want to use, that's how I want us to look at these four journals that I have specifically talked about. So what I'm going to do is to give you a format of the first four journals, which are the sales journal, purchases journal, sales return journal, and then purchases return journal. And the good news is that all these four have the same format, that when I give you one format, you can use it throughout for all these four books. So once I give you a format for this, then you will be able to use it throughout for all these four journals. So format of the journal. And remember the journals that we are talking about. We've said we are going to talk about the sales journal, purchases journal, sales return journal, and then the purchases return journal. So we have the date. We start with the date. That's when the transaction happened. Then we put the details, or what we call particulars. These are the details, what that transaction is all about. The format of the journal. Format of the journal. Format of the journal, we start with the date. We start with the date, followed by the particulars column, or what we call the details. Then we have the folio. Folio, I told you, it is more of a reference. Folio. This folio column is always small. You can call it folio or ledger. Then you always have the details. The details, then the amount. The amount is always in, you put the currency. So you can put it as shillings, So here it depends on the heading that you have. It will depend on the headings that you have. It might be a sales journal. So any heading that you want to give to this format, if it is a sales journal, then you call it a sales journal. Of course, you call it a sales journal on the top, then you proceed and go ahead to write what you want to write. But the same format will work for purchases journal. The same journal will work for the returns of both purchases and the sales. So there is a date column as the first one. We always have a date column as the first one. There is also a column for particulars. There is a column for particulars. There is also a column for folio, or this one you can call it a ledger. There is also a column for details. This column for details, and there is also a column for amounts. So detail column, this one and this one. The detail column, because in the details, it's where we will work out for the discounts, if any. Within this is where we are going to have things to do with the discounts, if they are there. Either discount received or discount allowed. Now, of course, this one is also in shillings. We put it in shillings because the amounts are going to be in shillings. Now, we have to take note that this format, like I said, it works for all journals. And then what you should also remember is that these books don't follow a double entry system. They don't follow a double entry system of recording. So when you are recording to them, they don't follow the double entry system. Otherwise, if they were following the double entry system, then they would be called principal books. So it is very simple, because when you meet any transaction, be it, as long as it is a credit sale or a purchase, you are not supposed to do a credit or a debit when it comes to books of original entry. And what you only do over here is to list. You just list. This is just a list where you just list the transactions in order of occurrence, which is what we call the chronological order. Now, as I said, we start with the dates, then particulars, and these will be the same name for debtors or creditors, and then followed by, of course, the dates here that we are going to have. We are going to have the dates for when the transaction happened, and within the particulars, we are going to either have debtors or creditors, depending on which one we are working on. If it is a purchase, then we are going to have creditors. If it is a sale, then we are going to have debtors, because they are going to be on credit sales or credit purchases. Then we shall have a folio or a ledger, and that will be a number that will be referencing either a debtor or a creditor or a supplier. So it can be because you may be having very many suppliers who have given you goods on credit. Maybe you have supplier 001, 002, 00. So you give them supplier numbers, and the same applies to the debtors numbers. So this 001 will be reflecting in the purchases ledger. I hope you are getting, because now if let's say you have written maybe Chuck's Holdings Uganda Limited as maybe your supplier, you'll find that Chuck's Holding will have his ledger account, and this ledger number will be appearing there. So when you are posting these transactions, you will also have to include these reference. They are just reference numbers. Of course, when you look at this journal, if let's say it is a purchases journal and you have maybe a ledger number 001, you will just check, maybe it is this supplier 001. Then when you look at that, it will give you a reference where to find this same information for that particular supplier, because you might receive one supplier or 5 suppliers, but each supplier is going to be supplying you goods or products or services at different intervals. So you may find that one supplier has supplied the business maybe for 5 times in a year. So you'll have those different items, but they are going to be all belonging to a similar supplier number, because you allocated those supplier numbers to each and every individual. So the folio column will be followed by the details. This details column is where we are going to calculate the discounts. And the discounts we are going to apply that are going to be here are the ones that are discounts which are not of cash. We don't have cash discounts here, because we said everything that deals with the cash is supposed to be in the cash book. So the discounts that we are talking about here, they are going to be what we call the trade discounts. Trade discounts. They are not cash. Maybe someone can tell you, if you buy 10,000 kgs of sugar, I'm going to give you maybe a 50 kgs free. So you'll find that this is a trade discount. It's not a cash discount. So those trade discounts are the ones that we are going to be adjusting in that details column. That's why you are seeing we put shillings, we put currency to show that we are actually going to have amounts there. But it's not a must that on every transaction, either a purchase or a sale, we are going to have trade discounts. So we shall look at the different aspects to do with the discounts. But one key thing that you need to note is that these are trade discounts. They are not cash discounts. And we'll explain later when we take maybe a practical question. Then the last column, of course, we have the amounts. That's where we put the final amounts. However, we said that there is a discount. There is a discount, but the discounts we refer to here is different from the cash discount that we use or that we normally see in the 3-column cash book. You have to take note. So the discount in this is different from what we see in the 3-column cash book, as well as the discount we see in the ledgers. Because what we see in the ledgers or what we see in the 3-column cash book is what we call the cash discounts. But that's where because within the ledgers, the cash book and the other ledgers, that's where we have those 2 different types of discounts, which is a discount allowed and then the discount received. But here we have trade discounts and not discount allowed or discount received as they appear in the 3-column cash book. But our 2 main types of discounts, we have trade discounts and then cash discounts. But among the cash discounts are also categorized into what we call the discount allowed and then the discount received. But the trade discount is different, and when it comes to the day books, then it's the trade discounts that apply and the cash discounts don't apply, but the cash discounts will appear in the ledgers, and that's the difference. I hope you'll be able to understand this, because you may get confused. So once we see that we have, maybe in the question we have been given trade discount, then we can apply it. But if you see that they have given you cash discounts, then you are supposed to ignore them, because it's not related here in the day books. They are not recorded here in the day books. And that's the practicability of trade discounts and cash discounts as far as the day books are concerned. We don't have cash discounts within day books. So without wasting time, I would like to take maybe a practical simulation, and we try to be a little bit straightforward to see what really transpires or what really happens when we are trying to solve a practical simulation. So let's write down the question. Simulation. Let's just use any sole trader here. Let's say Ivan, Ivan, a sole trader, Ivan, a sole trader, made the following transactions. The following transactions in January 2023. So we start with January. We are January 2nd, credit purchase from KC Group. We have the amount as 4,000 Ugandan shillings, comma, Stuart 3,000, comma, James 2,500 shillings, full stop. In each case, we are continuing that in each case, a sole trader received a trade discount. In each case, a trade discount, let's just say a trade discount of 10%. A trade discount of 10% is allowed. Trade discount of 10% is allowed. Then we go the next transaction. The next transaction happened on January 5th. We have credit sales to Bosco. Credit sales to Bosco, 5,000 shillings. Linda, 3,000 shillings. Emma, 2,000 shillings. Full stop. In each case, trade discount of 15% is allowed. Then the next transaction happened on 10th. Credit purchases from ABC Limited of 4,000 shillings. Samota Limited, 2,500 shillings, comma, Odong 2,700 shillings, full stop. Then the other transaction happened on 15th, where we have credit sales to Okelo, 6,000 shillings, comma, John 3,500 shillings, comma, Julius 4,500 shillings, full stop. Then the other transaction happened on 20th. Ivan returns goods to Stuart worth 200 shillings, comma, James 300 shillings, comma, ABC is 500 shillings, full stop. Then the other transaction happened on 25th. That is goods returned to Ivan from Bosco. From Bosco we have 1,000 shillings, comma, Julius 400 shillings, comma, Okelo 800 shillings. Then the other transaction happened on 28th. 28th we have a credit sale to Linda, 6,600 shillings, comma, subject to 15% trade discount. Subject to 15% trade discounts, comma, then John 1,800 shillings, full stop. Then the transaction that happened on 30th was a credit purchase from KC Group, 3,000, comma, ABC 2,200 shillings, comma, this one's a full stop. So we have the required part A, open a relevant subsidiary books. Open the relevant subsidiary books. Then part B is post the items to their relevant ledgers. So that's what we have. So we want to look at the solution. How do we able to do what they have told us to do? Now, what we are going to do is that we are going to open the relevant, for part A, we are going to open the relevant subsidiary books or books of original entries. And we are going to use the format that we have just seen. So we are going to put all those items in their respective subsidiary books. But part B, they want us to post the transactions to the ledgers, post to the relevant ledgers. And we said the ledgers are either ledger accounts or a cash book. So that's all that they want us to do in this number. So you can go through the question and see what they want. So they told us Ivan, a sole trader, made the following transactions in January 2023. They started with January 2nd. We've seen some credit purchases. They went on to June 5th. Then we had some credit sales. They went to January 10th. We had some credit purchases. Then we went to 15th and we had some credit sales. On 20th, we had some returns. Ivan returned goods to Stuart. We need to know, is Stuart, because Ivan is the business. So if the business is returning goods, it must be, these people are supposed to be suppliers, because Ivan can only buy from the suppliers. So once you see Ivan returning goods, then you have to know that these Stuart, ABC, and James are suppliers. Then on 25th, they told us goods returned to Ivan. Goods were returned to Ivan. Ivan is our business. So Ivan is a sole trader. So they are returning goods to the business, meaning that these were the customers returning goods to the store. So Julius, Okello, and Bosco, they are supposed to be customers to Ivan. Of course, on 28th, we had some credit sale to Linda, then and James and John. So the last transaction that happened on January 30th, we had credit purchases from ABC and KC Group. So those are the things that we are going to look at. So what we are going to do, we are going to make sure that we draw each of these accounts. We can draw all the 4 formats at once, because we said we are going to be having the same format. It's only the headings that are going to be changing. We are going to have the same for purchases, for sales, and then the sales return and the purchase return journals. We are going to have the same format. And that's basically what we are going to do. So we have Ivan as a trader, or as a sole trader, who have made the following transactions. So we have seen the first transaction happened on January 1st, on January 2nd, where we had credit purchases from 3 people. And each amount, we are going to be deducting a 10% credit discount. But now we know that credit purchases go into what we call the purchases channel. And as I told you, that it's only the cash purchases that will not appear in the purchases journal, because we told you that those ones will go into the cash book. So if there is anything that is related to cash purchase, will be transferred to the cash book. So let's now maybe have the format. We start with that first transaction. We start with the purchase journal. It's a purchase journal. You can start by writing the name of the person That is the sole trader. That is purchases journal. The format is we start with the dates. We have a column for particulars. We have a column for folio, or what we call the ledger. But this one is always a small column. Then we have details. Details column is where we write they are also supposed to be in shillings because that's where we write the discounts. Then we have the amounts in shillings. So that's our format. So the year must come first. Told us it was 2023, 2023, January 2nd. So we start with the year, followed by the month, and then the date. So that's the format that we use in accounting. And because we assume that the days will keep on changing frequently, then when you have finished writing the year, then it's supposed to be followed by the month, and later on followed by the date, because most times the years don't change so much, and even if they change, they will still look uncongested. So the 2023 January 2nd, it's under the purchases. So it will come into the purchases journal, and the things were purchases from KC Group. So we have KC Group, but they told us in each case a 10% discount. So we write KC Group as particulars, and then because there is a discount, then of course if this part was, since there is a discount, then we are supposed to adjust this for this 4,000 that was paid. But if there was no discount, then this space was supposed to be left blank. Then we put the whole 4,000 this side. But since there is a discount, we have to adjust this 4,000 here. The 4,000 is going to be adjusted by 10%. So we have to less discount. I'm just going to write discount, but just know it is the trade discount. Discount of 10%. So what is 10% of that? 10% will be 400. Once you less it off, then the balance will be the amount that you are going to take this side as 36. We are done with that person. Then we go to this. On the same date, we happen to have another supplier called Stewart. Still, we less off the discount, and this Stewart we supplied us goods that were costing 3,000. So these were 3,000. Then you less off the 10% of the 3,000 gives you 300. Once you less it off, you'll have 2,700. We'll do the same thing for James. James supplied us goods worth 2,500. Then less the discount. Less the discount. The discount 10% of the 2,500 will give us 250. So it will be a 250. If we less it off from that, we are going to get the 220, the 2,220, the 2,250 is 2,250 shillings. Then we look for another credit purchase. The next credit purchase happened on 10th, January 10th. So we are seeing that we don't write the January again. We just go on the date. We sold to ABC, and this amount never had any discount. So we will leave the discount part empty, and we will record the whole amount as 4,000. On the same date, we had the Samota. Samota also never had discount. Supply 2,500. We had also from Odong, same, we never had any discount. So the amount is 2,700. Then the last one happened on 30th. We got goods from KC Group. still never had discount, so it goes to 3,000. Then from ABC as well, which never had discount, which is 2,200. And that is all that we had to do with. That's all that we had to do with the credit purchases. So we get now the total. This is when you add all of them, you get 22950. 22950. That is the total you close off. That's how we close off the account. So we have seen that the second transaction that happened on the same day, the one for Stuart, we also adjusted for the other column. We adjusted for the 10% tax. Then the one which happened on 10th and 30th never had anything to do with transaction, with trade discounts. So the same thing that we have just done for this credit purchase journal, or the purchases journal, is the same thing that we are going to do for all the day books until we finish them, because that's the only thing that we are required to do, since we are not going to be following anything to do with double entry system. So we shall do the same thing for all the journals. However, when we reach at the sales, at the returns day book, whether we are looking at return inward or return outward, for you to be sure, you need to be sure that it's indeed a return. Because for you to know that I actually have a return, then you must look at a corresponding name of either a supplier or a customer. That is either a creditor or a debtor. So once you see that you have a return, you have to make sure that there is a corresponding creditor or a debtor in the purchases journal or the sales journal respectively, for you to recognize that indeed it's a return. Because the idea is that you cannot return something that you did not buy or you did not purchase. Then the other thing that you need to note as far as returns are concerned is the fact that you need to understand that when it comes to returns, we need to be careful, because when you are returning goods to the supplier, or when the customers are returning goods to you, then you need to be very careful for you to consider the fact that whether these customers or these suppliers gave you a discount at the time of purchase or at the time of sale. So whenever we are returning, we have to be sure that at the time of purchase, maybe from the supplier, or at the time of selling to the customer, we either enjoyed trade discount or not. If we have enjoyed the trade discount, then as we are returning the goods to either the supplier or when the customer is returning goods to us, we need to subtract the discount that they enjoyed in the question. If let's say for instance, if someone bought, maybe, like for instance, we bought these items from ABC for 4,000, but you find that you have enjoyed the 10% discount. That 10% discount of 400 we have enjoyed when we have purchased 4,000, meaning we only paid 3,600. We didn't pay the full 4,000 for the goods. So even when we are returning the goods, even if we are only returning, maybe we are returning 200, we are returning goods worth 200 shillings to the supplier, then we have also to subject this to the discount, to the trade discount that we received. If we are returning this and the trade discount was 10%, we are supposed to make sure that within the details here, we write the 200, then we adjust by the 20, so that we can only deduct 180. which is the 90%, because we enjoyed a discount of 10%. So the discount that we enjoyed, either whether we gave a discount to the customer when we are dealing with the sales return journal or the purchase return journal, we have to make sure that we adjust the discount that we enjoyed. If we have not enjoyed any discount, then it's okay. We can take those figures the way they are. So you need to be careful with that. Then the other thing, as of course, when you are done entering all the values in the different journals, then what is left will be closing off the journals. As we said that when you are closing off the journals, you just add up the amounts in the amounts column. You just ignore the rest of the columns, and that's all that you are supposed to do with the journals. But before we conclude, let's talk about this folio, because we've skipped it. The folio column, this folio column, this one. The folio, I've told you that this is just a reference section. And I also told you that it's not all that important for you to actually consider this folio section, because at some point you can skip it. Other books you may find when they are skipping it, other books are emphasizing that you put them. But when you are computing, it's more important, especially in practice. You have to at least indicate, because sometimes the documentation, the items may be so many that you may fail maybe to number some of them. But when it comes to ledger folio, it means it is more of a reference column that tells you where else you'll find this kind of information that is contained in each of these journals, because we are preparing each of these journals independently. So it shows us where else we can find this information. For example, the information in the sales journal will be found in the sales ledger, meaning the values of the different customers will be found in the sales ledger. So if this was a sales ledger, we would just put sales ledger SL, maybe we give it a number 001, depending on the different customers. That's what we are meaning for a sales ledger. And the same happens for these other ledgers. For example, for this purchase ledger, of course, we shall find this in this purchases journal. We shall find the information within the purchases ledger PL. You can put maybe PL 001 for the different customers, 001, 002, 003 for the different suppliers that we receive goods on credit from. So the PL will be the purchase ledger. However, we said that ledgers are basically pages, meaning that each customer will have a different page number, meaning that when you want to make a reference, then you should show that customer A or supplier A will be in a sales ledger or in the purchases ledger number this, but you go ahead to add a page number, because this is just PL, that is purchases ledger. But we say that these ledgers, they are like books. So we have to know that this customer is on such and such a page. Maybe customer PL, supplier PL 002 or 003, depending on the numbering that you have used. The same applies to the sales ledger. You may use maybe SL 002, 001, 003, and so on, depending on the number of customers. And these numbers that you have indicated will be the pages, because this is a book, a day book. We keep recording these transactions on a daily basis, and we record them in the order of their occurrence. So if I have received goods from KC Group and this supplier was 001, the moment I have another supply from the same person, I will just write the same reference or the same folio. So that's the implication here. It will be that when I go into my ledger account, I'll just look for a customer KC Group and I find the information is within the purchases ledger, but on page maybe 002 or 003. Because each customer or each supplier is going to be on a different page. So you create one page where you are going to be writing all the items that you have received from that supplier or all the items that you have sold to that customer. Each customer is going to have a page where we are going to be writing all the transactions that we are going to be going through with that same customer. So when it comes to the totals, of course, that's the same thing that we are going to be doing for all the journals. But now when it comes to getting these totals, getting the totals here, or when we are balancing off, we do the same thing that we are going to do to each and every journal. But now when it comes to these totals will be found in the general ledger. As far as the folio is concerned, it will be in the general ledger, because in the general ledger, that's where we are taking all the information, the totals that are relating maybe to sales returns, that are relating maybe to purchases return. Here for the total, it will be found in the general ledger, because it is this general ledger that records many transactions. So you should be specific as well to identify where these totals are going to be found. So it is just a reference, the folio is just a reference item or a reference column. So you'll do the same thing for the purchases, for the returns, and others for the different journal pages. So these are the specifically important things, especially for the work issues, than in the examination. But even though we are saying that they are not all that important for examination purposes, you need to make sure that you give the correct reference, because if you don't actually know where certain item can be found, it's better to ignore and you don't put anything than putting a wrong thing. If you put a wrong reference, then it means you are just making your work complicated, because if someone opens the total and they maybe you have referenced these totals as maybe page purchase ledger, it will be a wrong thing, because in the purchases ledger, we are going to have details of so many customers. Each customer is going to be on a different page. So you'll find that you are misleading the reader. But these are mainly done at work, because you are going to be doing so many numbers. You are going to be handling maybe very many customers, and you need to have information that is relating to your customers. So that's basically what we are required to actually do. So what I'm going to do is I'm going to try and draw the rest of the journal entries, but make sure you also do on your own so that you can be able to keep practicing. This I'm just going to take very less time trying to draw them. So we are using the same format. Let's maybe look at the purchases return journal. The same format. Let's have the particulars, we have the folio, we have the details in shillings, we also have the amounts in shillings. So this is 2023 Jan. The first transaction on returns happened on 20th, where we had Stuart, that is the supplier, but we had a discount. The return was 200. one we had a discount of 10%, so we less discount than 80. That is the return amount that we'll be having. Then we have James. The amount was 300. We have to less return the discount. 10% of the 300 is 30, and that will give us 270. Then we have ABC. For ABC, we never had any discount, so it is 500. Then we close off. That's the only thing that we had there. We get the totals. We just add this column. We ignore the rest. This is 950. As I told you, this will be found in the general ledger. So these are purchase returns that will be transferred to the purchase returns account. Then we do the next one. We can now start with the sales journal. Then we conclude with the sales return. Sales journal, and have the dates, have the particulars, have the folio. We show the details, the shillings, then the amount. Amounts also, they are in shillings. So this one happened on Jan 5th. That is the first transaction. The customer was Bosco. We gave a discount, so less discount. But as I told you, this is a trade discount of 15%. Bought 5,000 for 5,000. Receive 15% of the 5,000 will be 750. So we take that off, and it will be 4,250. Then we had a customer called Linda. The amount was 3,000. Then less the discount. The discount was 10%. 15% of the 3,000, that is 450. When you less that, it will give you 2,550. 2,550. Then we have Emma. Emma, the amount was 2,000. This one also enjoyed the discount, so we less off the discount. The discount was 300, 15%, and that gave us an amount of 1,700. So the other sale happened on 15th. The other sale happened on 15th, and it went to Okello, but we never had any discount, so it was 6,000. 6,000. We had another sale to John, which was 3,500. We never had a discount. We had another one to Julius. Of 4,500. Then on 28th, we had the one to Linda, but we gave this one a discount, so less the discount. The amount was 6,600. Then we less off the 15%, that is 990. When we do that, we get 5,610. Then we had John. John never had any discount, which the total amount was 1,800. So we get now the total. Totals. The total, of course, it is 29. $29,910. That is our total. the totals that will be found in the general ledger. Then finally we conclude with the sales return journal. Sales return journal. We conclude with the sales return journal. We have the dates, have the particulars, we have the folio, we have the details, we have also the amounts. Of course, we have the ones that happened on January 25th. We have Bosco. The amount was 1,000. He enjoyed a discount of 15%. So less the discount, which is 150. That gives us 850. With Julius and Okero, they never enjoyed. So Julius, the amount was 400, and Okelo,